5 years as a practicing company secretary. The Gaurav is also qualified company secretary, and he has done his master also, MBA also. And yeah, so he's also involved into the insolvency and bankruptcy work also. So let me formally welcome you, Gaurav. Nice to see you. So we have this Saturday webinars which we run for more than now almost more than 2 years now, and it is continuing. So the objective is to share the knowledge and yeah, no, so and take a different views from different faculties. So thank you, Gaurav, with us. We also have a Mr. Sudhakar, who is part of our Mehta and Mehta team, and he comes with more than 3 decades of experience. And the last assignment where he has retired from was in Reliance Industries Limited. Sir, welcome you. And our own Bala, he has again, almost 4 decades of experience, and he's a prolific writer. He regularly writes in the various legal magazines. So, Professor Bala, welcome you to this webinars. So, I'll request Mr. Bala to take over, and then probably he can take it forward. Yeah.
As you know, today topics we are going to discuss on the accounts of the companies. And I would request our faculty Gaurav to share his thoughts about the topic and the importance of this before we start. Over to Gaurav, please.
Yes, sir.
So before we request Gaurav to speak, Sudhakar ji, any initial remarks?
No, Sudhakar, we'll ask him after our panelist speaks.
Acha, okay.
Yes, sir. Thank you.
Yeah, go ahead.
Good morning, all. Good morning, all. Thank you for the introduction. The today topic is on financial statements. The financial statements are the backbone of the companies. It is not the financial wealth of the companies. The topic is section 128, and one second, sir. Today's topic is on insight into accounts of companies regarding financial statements. The topic covers accounts of companies, read with companies rules. A small brief I should give about accounts. It should be maintained by every company, such as small company, private company, OPC, because it is the financials are the financial wealth of the promoters. They know about their profit and loss. It is mandatory for every company to maintain the books of accounts, and compliance regarding this, regarding ROC compliance is also should be there, such as Form AOC 4 and MDT 7. We will file, the company should file, and it in the respective timely manner as per law. If we not file the annual filing, not done the annual filing, then there are so many penalties regarding non-compliances. There are have used penalties are there by the ROC. One second, if we talk about the books of accounts, then it should be kept at the registered office. And if the company wants to change its books of account, place of books of account, then it should be kept on other places by the approval of board of directors. And it should be for the period of 8 years. And if there is any legal proceedings are going on, any investigations going on by the ROC, by RD, by ED, and by other government statutory department, then the company should not destroy the books of account. And there is also if we read about director's report, then director report is also mandatory to be enclosed with financial statements, and it should be approved by the shareholders. Then there are various contents in the board director report, that is web address, board meetings, number of board meetings should be held, director responsibility statements, independent or director declarations, auditor and secretarial audit comments, loans, guarantee and investment. But it depends on the company's structure, that it is a small company, it is an OPC, and it is a public limited company or a private limited company. It depends on the structure of the company. If it is a public limited company or and it is listed company, then the director report is, then there is SEBI LODR is also there for to maintain the director report, to disclose the director report. And if we disclose that the company disclose dividend, then there is a recommendation amount of dividend and policy are also to be disclosed. Then if we talk about internal auditor, then internal auditor is also necessary for the some classes of companies as may be prescribed under section 138 and rules. If we is a internal auditor appointed by the board of directors of the company, and it should be mandatory for the listed company and every unlisted company that is paid up share capital having 50 crore rupees, turnover of 200 crore rupees, or outstanding loans more than 100 crore rupees. Then this is a brief regarding books of accounts of the company, because without books of account, the company cannot grow, the company cannot represent its financial statement, and its auditors also benefits, its shareholders and members also benefit while giving the seeing the financial of the companies. Then we will, if it is a listed company, then we will show the financials and we will see the financials before investing in the stock market. This is my overview regarding books of accounts overall. Thank you.
Over to Mr. Sudhakar, please. Your thought.
Yeah. Good morning, everyone, and thanks, Bala. As Gaurav has mentioned, that financial statements as well as the accounts are the very important for any company. And as a company secretary, my experience is that most of the company secretaries are quite reluctant, and they need that the kind of understanding, the depth of understanding what about the accounts and financial statements, what a company secretary has to have, how much it is there. I have my own apprehensions about it. This is what my experience with the company secretaries. However, our institute, understanding the importance for our profession, in the syllabus, both accounts as well as finance management has been given equal importance, as if the amount of importance what has been given to the Companies Act. There was a contentious issue long back that when the company secretary is signing the financial statements, apart from the directors, earlier CFO signing was not mandatory, though it is mandatory now. So apart from the directors, only the company secretary who is to sign that. How far and how much the company secretary is responsible for the accuracy and integrity of the financial statements. There were several discussions that have taken place, and ultimately it was more or less concluded that company secretary primarily is not responsible for the accuracy and integrity of the financial statement. That is the responsibility of the CFO and other the finance department. But as far as the secretary is concerned, he is only attesting apart from the directors. But under the new Companies Act of 2013, whether we can take the same stand, I have my own doubts about it. Though the company secretary primarily may not be responsible, but he cannot ignore his own responsibility as far as the accuracy of the financial statements, because the company secretary, his responsibility is to comply with the provisions of the Companies Act 2013. So if not directly, indirectly, the company secretary is all responsible for the integrity of the financial statements. So it is advisable that the company secretary should have a good knowledge about Schedule 2 as far as the depreciation is concerned, Schedule 3 as far as the formatting in which the balance sheet, profit and loss accounts are to be prepared. And at the same point of time, when a company's balance sheet is prepared or the financial statements are prepared, he has to take the responsibility for Schedule 2, Schedule 1 as far as the capital is concerned on the liability side I'm talking about. And apart from that, the reserves and surplus, secured, unsecured loans, fixed assets presentation. At the same point of time, the notes to accounts about the contingent liabilities, related party transactions, 186 disclosures, what are to be given. There are several aspects like this. The Companies Act provisions need to be taken care of. At the same point of time, the financial statements have to reflect the true and fair view of the affairs of the company. So the company secretary has to have proper understanding about the true and fair view of the accounts. At the same point of time, the accounts of the company are to be prepared on ongoing concern basis. During the COVID period, this issue has cropped up because several companies, the chartered accountants, the auditors of the companies have raised this issue of ongoing concern basis. In fact, around that time, I remember that some of the company secretaries used to call me and to understand that what is this ongoing concern basis. And because of the COVID period, considering the uncertainty of the businesses, the auditors are raising the issue of ongoing concern basis, how the issues are to be addressed to. So these were a few issues which has come up. Apart from all these things over and above, before I conclude my remarks, I must say that the bigger companies these days are preparing integrated financial statements. So the company secretaries do have to understand that what are the integrated financial statements, that wherein we are giving, apart from financial related information, non-financial related information about the companies are also being furnished. So my advice to and submission, humble submission to all the participants is, do give a thorough reading, if not for every financial statement of every company, at least pick up top 5 company listed companies financial statements and go through that at your own convenience. Please go through that from page number 1 to page number till the last page and try to understand that how the financials are being presented, how the issues are to be addressed. Auditors' comments were there, notes to accounts are there, contingent liabilities, related party transactions, reflections. This is a big task, okay? This to understand the financial statements is also an art which needs to be developed over a period of time. So I give a pause here and request Bala to take it further. And during the presentation, we can discuss further nuances of financial statements. Thank you.
Good morning to all of you. I can see from the number of the participants now, as it is before the start of the session itself, which is around 170, which show the importance of the topic and the perspective. Second thing is, I must acknowledge the receipt and appreciate what Mr. Sudhakar has said. I 100% in agreement with him, because the financial statements goes along with the board report. There are various disclosures which are actually required to be made. When it's come to the disclosure requirements, basically the company secretary is actually responsible. I have been actually seeing it, as Gaurav was telling, there are a lot of non-compliances, etc. Many non-compliances have actually come out on the director's responsibility statement. Because directors have to categorically make a responsibility statement in the board report saying that they have consistently applied the accounting policies, they have framed the accounting policies, they have followed the various accounting standards specified the Institute of Chartered Accountants of India. All the things are they are not to refer to made. And one of the things what he touched upon is the going concern basis, which also need to be addressed. As he rightly pointed out, during the uncertainty period of the COVID pandemic, this issue was there. A lot of things have been discussed. How do we actually ascertain the concept, etc. Various judgments are also there on that. But the only thing is, yes, per se, for the figures which are appearing in the financial statements, the company secretary may not be responsible for the accuracy of the figures, for which another KMP, there's namely the chief financial officer, other related people, they are actually responsible for the accuracy is concerned. But as per the adherence of the accounting policies, adherence, internal control, internal check, various disclosure requirement, which is ultimately emanating from the financial statement, which has been reflected in the board report, for which the company secretary is definitely responsible. Not only that, financial statement not only contains only the facts and figures, but also it contains other notes to financial statement, notes to balance sheet, notes to profit and loss account, etc. As well said by Mr. Sudhakar on the liability side, capital side, etc. Various notes explaining the things, etc. These disclosure, which are actually called for. So naturally, the company secretary has to understand what is the requirement, And in fact, about few weeks back, we had a detailed discussion on the board report where we touched upon Secretarial Standard 4, which is actually not a mandatory one, but it is a voluntary one, which actually spells out n number of things in line with the Companies Act, which is nothing but a complement to the Companies Act provision. In fact, very recently, I saw one of the adjudication order, some disclosure requirement. He specifically referred Secretarial Standard 4 requirements have been not followed. And in that company, along with the director, even company secretary was one of the party who was actually fined in that judgment. So these are all the various issues which are there. The company secretary cannot keep aloof himself from the financials. He has to get involved with the financial. He has to understand what is the thing, adherence followed, especially. And not only that, over and above, it is also a responsibility of the statutory auditor to see, as per the financial statements concerned, when they are certifying a true and fair view, the necessary company law compliances and bid, the accounting standards have been actually followed. If the non-adherence of the accounting standards, non-adherence is followed by the companies, it is not only the company and the director responsible, it is also equally responsible for the statutory auditor. There have been cases where the statutory auditors have not pointed out those cases where they have also been penalized. So these are all the issues which are actually there as per the accounts and financial and related documents are concerned. I think Mike is going to take us over all these areas, starting with the Companies Act, accounts and related matters, internal audit, internal control, and even specialized agency, NFRA, which has been actually established with the Government of India, on which there are a number of cases have been referred by SEBI to NFRA. There are a lot of judgments actually has come to the extent of levying a heavy penalty on the statutory auditors and also debarring them from their services, etc. All those things are also there, you might be aware. So I'll ask Mr. Mike to take us through. And as usual, I request the participants to raise their queries and doubts, etc. in the chat box. We will be taking it from then and there. At the end of the session, we will permit you to raise your hands. You can actually speak and we can discuss it out. Over to Mike, please.
Thank you so much, Bala sir. Welcome everyone. My name is Mehta. I am an Assistant Secretarial Officer at Mehta and Mehta, and I welcome all at the Masterclass on Companies Act 2013 and insight into accounts of companies. Yes. So welcome to Chapter 9, Accounts of Companies, read with Companies Accounts Rules 2014. This chapter provides a comprehensive overview of the regulatory framework governing the financial and accounting practices of companies. It is a crucial segment of company law focusing on the maintenance, management, and reporting of financial information. Understanding these regulations is vital for ensuring transparency, accountability, and compliance within the corporate financial management. A brief about the books of accounts of companies. One of the key obligations of any company registered in India is to maintain proper books of accounts as prescribed under the Companies Act 2013. The Act mandates that every company, regardless of its size, must maintain accurate records of its financial transaction, which should provide a clear picture of its financial health. In this webinar, we will discuss the legal provision related to maintenance of books of accounts, various forms to be filed, and financial concepts that are relevant for the companies to comply with the Act. The legal provision of maintaining the books of accounts. Legal provision of maintaining the books of accounts under Section 128 of Companies Act 2013 mandates every company to maintain a proper books of accounts. The books of accounts should be kept at the registered office of the company or at any other place where the board of directors decides. The books of accounts should be kept in such a way that they give a true and fair view of the state of affairs of the company. The books of accounts should be kept on accrual basis and should be in accordance with the double entry system of accounting. The books of accounts should be kept for a period of not less than 8 financial years. In case of any ongoing legal proceedings or any investigation initiated by the government, the books of accounts should be maintained till the completion of such proceedings. Companies Act 2013 also requires that the companies maintain various other books and registers such as register of members, register of shares, register of directors and KMP, a register of charge, and a register of debenture holder, etc. The rules mentioned in the Companies Accounts Rules 2014. In these rules, unless the context otherwise requires, Act means the Companies Act 2013. Annexure means the annexure of these rules. Fees means the fees as prescribed in the Companies Registration Office and Fees Rules 2014. Forms or e-form means forms set forth in annexure to these rules which shall be used for the matter to which it relates. Indian Accounting Standard means Indian Accounting Standards referred in the Rule 3 and the annexure to the company's Indian Accounting Standards Rules 2014. Schedule means schedule to the Act. Section means section of the Act. The word and expression used in these rules must but not defined and defined in the Act or in the company's specification of definitions and details, Rules 2014, shall have the meaning irrespectively assigned to them in the Act or in the said rules. Section 128, Books of Accounts. Requirement for maintaining books of accounts. Every company shall prepare and keep at its registered office books of accounts and other relevant books and papers and financial statement for every financial year. Must be maintained on an accrual basis and follow the double entry system of accounting. Rule 2A, for the purpose of the first proviso to subsection 1 of section 128, the notice regarding address at which books of accounts may be kept shall be in the form of AOC 5. The content of the books of accounts, it must give a true and fair view of the state of affairs of the company, including that of its branch office and offices, if any, and explain the transaction affect both at the registered office and its branches. It should accurately reflect the company's financial position and operations, including all receipts, expenditures, sales, purchase, assets, and liabilities. The retention period, books of accounts must be preserved for a minimum of 8 years preceding the current financial year, provided that where an investigation has been ordered in respect to a company under Chapter 14, the central government may direct that the books of accounts may be kept for such longer time as it may deem fit.
So, Mr. Bala, we have a many questions with respect to keeping in accounts. I think our speaker, Mr. Gaurav, also said you have to, of course, there is a requirement of 8 years, but then in case of litigations or the other challenges, you have to go beyond those 8 years. Now, as a company secretary, if I'm a company secretary of any company, so what is that, I have to follow? I mean, so if there are litigation in my company, I cannot hold those, books of account indefinitely, right? I mean, there has to be some kind of a cutoff. Yeah, Gaurav, what is your view? Gaurav is there?
Yeah.
Yeah, Sudhakar ji or Bala?
See that legally a company has to maintain the financial statements as well as financial statements. Of course, they have to do it in perpetuity. As far as the account books are concerned, they have to keep it for a period of 8 years. And wherever the litigation is going on, litigation may be on account of the regulators might have challenged the accounts, or any shareholders might have challenged, or there might be some kind of a disputes with the taxation authorities, indirect taxation authorities. Like that, there may be several issues. In such cases, unless until the assessments are completed, till such time the books of accounts are to be maintained. In fact, in the good olden days where the physical records were there, that point of time this issue is there. But nowadays, most of the companies are maintaining this in the electronic mode only. So I don't think anybody is really destroying the accounting records, because say, at any point of time, you may have to refer to the financial statements and the transactions related. So I don't think anyone is as such recording, destroying the accounting records are concerned. But yes, legally, there are certain requirements out there. You don't need to maintain beyond 8 years. And if I am not wrong, income tax also having certain time period, which is in addition to the Companies Act. I'm not very sure at one point of time, if I am not wrong, it was 16 years or something like that was there. I don't know at this point of time what it
In
was.
income tax, excuse me, sir, in income tax, there is also a provision of 8 years. If we go for financial, yes, sir. If we go for financial.
In fact, different regulations have got a different period of retention depending upon the things. In fact, excise and customs, they said either minimum period of the 5 years or till the assessment of that particular year is actually over. Yes, you're right.
Sir.
Income tax, it was there in 16 years. Now I think it has come to the 8 years period. To address the question of Atul Mehta, how long, what is the thing? I'll tell you one thing. I was working in a company which has completed about 50 years. When it has completed the 50 years, company wanted to write a history of the company. When the company wanted to write the history of the company, when I got back, I could trace actually even the very first year of the accounts prepared and audited. It was in that company's book where we actually picked up where we started, what is it and all this. By and large, this sort of the document, generally company do not destroy. They keep it in the archive, they keep it there. It is there. Now added to it in the digital era, it is. But law requires it is only 8 years. But coming to the litigation part of it, once the litigation notice is actually issued, the matter is not sorted out. Whatever you say, it is your obligation related documents are required to be prepared by you and kept by you. But before the litigation has started, if you have followed the 8 years, there was no issue, etc. and all the things. By any chance, you have destroyed the books of account, it is not available. Then always you can actually justify since there was no reason, etc. and other thing and all. But the one the litigation, there is no other escape. You have to maintain till the litigation issue is actually sorted out.
Sir, I have a question here. So basically, as a company secretary, of course, I have to make sure that the compliance of the particular section under the Companies Act has been followed. But at the same time, there are some responsibility of the accounting department, particularly, when you have a large group or large company. So I have seen in a couple of companies where the company says, look, my data got corrupted. The account department, the head of accounts comes in, tells the company secretary, look, 3 years before, I can't trace because, all those were on a drive and got corrupted. Now, how do you react, I mean?
Then the company should register an FIR. The complaint registered should be, police complaint should be there that all data is corrupted or all data is destroyed.
So data corruptions should go to the police station?
Sir, complaint should be there. At least you should complain that, and you should see that if there is any investigation going on, and if your data is destroyed, then you should file the complaint in the police station that all the data is destroyed due to some technical error or.
Atul,
these days, Atul bhai, that any data is corrupted.
Yeah.
Data retrieval is not impossible. Data can be retrieved within no time these days. Okay, number one. Unless until somebody tampers with the data, somebody destroys with the data, that is a different thing altogether. At that point of time, maybe if the company is suspecting that somebody has deliberately destroyed the data or some with the data, then yes, an FIR is to be lodged. But as such, if the data got corrupted, definitely there are methodologies to retrieve that, number one. Number two, it is the responsibility of the company to ensure that within 6 months of the closure of the financial year, they have to prepare the financial statement, hold the AGM and present it before the shareholders. Whenever these kind of eventualities takes place, the company has to proactively approach the ROC for extension of the AGM for a period of maximum of 3 months only. But unless until the ROC got convinced that there is a genuine difficulty is there, that extension, whether maximum he can give 3 months, but he may give 1 month, 2 months, whatever it is there at all also. So it is the responsibility of the company and of the board of directors as well as of the KMPs to hold the statements and then to make hold the AGM and then do it. Otherwise, it amounts to a kind of non-compliances and all those things will be, those are the consequences.
In fact, you refer the, what you call data getting corrupted, etc. and all this. I go back about 30 years back when we were not having a digitalization, it was in the physical form. In one of our unit, we had the goods, which was actually accessible goods, and where the record concerning the entire excise records in the factory Due to the fire, it got destroyed. Unexpected fire broke out. Many records got destructed. Even one of the records were excess. Even the current year's record. But as per the excise, unless we complete 5 years assessment, we cannot actually destroy anything. So immediately what it is, the fire is actually reported to the police as such, the investigation was gone. Nevertheless, we wrote a letter to Central Excise Department saying this, etc. And further, we made a statement to the Central Excise Department. We would like to rebuild our records and we need the assistance from them. Those days, we used to submit what is called the stock register to them. There is something called RG1 format by which we have to submit the stock statement on month to month to them. Then ultimately, Central Excise has actually provided the necessary data from them. And from there, we have actually got those records and we created records and we got it certified from them. Due to the fire, original records have been discarded. This has been actually rated with the help of the Central Excise document, which will be preserved by us. That is what we have done at that particular time.
Yeah. So I think we have two people who raised the hands, Sagun, and so I'm allowing Sagun, you can speak. You have raised the hand, and allowing the Dinesh also to speak. Yeah, you have been allowed. Unmute yourself.
Yeah, hi. It was a wonderful session which is going on. My question to this keeping of records for 8 years or whatever may be the period, does it mean we also need to keep invoices, either hard copy or soft copy? Because accounts, as has been correctly said, the SAP or whatever system we have, we can go back to 15, 20 years. But what about hard copies of the invoices?
See, if a litigation is going, that point of time, even the backup documents are also to be preserved. If there is no litigation, as per the law, you have to maintain for a period of 8 financial years. But mostly the companies, what they do is they maintain the accounting records, if not the backup documents. It all depends upon the management's what's called as a decision, how long they want to maintain it.
Okay. So as long as there's a litigation period, be direct or indirect tax, you're suggesting that we should keep invoices and post that invoices are not required. Okay. Thank you.
Now, add to this one more thing.
Correct.
Generally what happened, the assessment, which is actually normally done within a period of 3-4 years. But the assessment is not done for a particular year. Say for some reason or other, even for the 7 years assessment are pending, then till the assessment gets over, you may have to keep your backup of the documents also till the assessment is over, because assessment time, these records will be called for. So that is another aspect you have to keep in mind.
Sure.
Because if the assessment is not over, if you say 8 years have passed, I have closed, then when the assessment time, they want to verify, invoices will be required in charge of the, assessing the taxability, etc. and other thing and all. So from that point of view, you have to be careful on that. Yeah.
Okay. Thank you, Mr. Balakrishnan.
Yeah, Dinesh, you wanted to, you raised the hand. You can unmute yourself and you can ask the question if you're there. Okay, he's not there. Okay. Yeah, Mayank, you can continue.
Yeah. The location where the books of accounts must kept. The books of account must be kept at the company's registered office. It can also be kept at such other place in India as the board of directors may decide, and where such a decision is taken, the company shall within 7 days thereof file with the register a notice in writing giving the full address of that other place. It can also be maintained in electronic form. Manner of books of accounts to be kept in electronic mode. Books and papers maintained electronically must always be accessible in India for future reference. These records must be retained in their original format, complete and unaltered, including information from branch offices.
I would actually request Sudhakar to share his thoughts about electronic versus physical records, because always there has been a confusion within the people. What is maintenance of electronic records? Please, Sudhakar, you are.
I suggest Bala is let section 128 be completed by Mayank. After that, I will discuss a few issues. At that point of time, I will discuss about this electronic records also.
Okay, fair.
Let him complete this 128 section at least.
Yeah, okay.
There must be a proper system for storage, retrieval, display, or printout of electronic records as deemed appropriate by the audit committee or board. These records cannot be disposed of or made unusable unless legally permitted. Additionally, backups of electronic records, including those stored outside India, must be kept on servers physically located in India on a daily basis. The company must annually inform the registrar during the filing of financial statement about the name of the service provider, the IP address of the service provider, the location of the service provider, the address provided by the service provider if books of accounts and other records are maintained on the clouds.
Yeah, just hold on. Okay, that give a pause here. Give a pause here. Just go back to the previous slide, Mayank. And also you can come back to the slide, where you are maintaining about accrual system, what is that? Next slide, next one. Yeah. See, this is one thing, okay, that if you see the section 128, that there are certain requirements are there in which the accounts of the company are to be maintained. This is the primary reason when I was mentioning that the company secretaries have to ensure that the books of accounts of the company are maintained as required under the section 128. In fact, with all due regards, some company secretaries even or doesn't know what is an accounting policy and what is an accounting standard. There is a difference between accounting policies of the company and accounting standards which are applicable to the companies. Accounting policies are what based on which the company's financial statements are prepared year after year. Whenever you prepare the accounts, there should be a kind of consistency in the maintaining the accounts, because whenever the financial statements are prepared, to analyze the financial statements, you compare the current year figures with the previous year figures. That's why there should be a consistency. You cannot change the accounting policies of the company from year to year without even disclosing that to the stakeholders. At that same point of time, there are certain accounting standards depending upon the size of the company, listed, unlisted, small companies, MSME companies, and all. Certain accounting standards are also applicable. There, a leeway is there that in case for any reason any accounting standard is not complied with by the company, then that is to be disclosed that what is the reason for non-compliance of that particular accounting standard and what is the financial impact of such a non-compliance. That is also to be given in the financial statements itself. And another important thing is that whether I need to necessarily close the accounts by 31st March, or I can close my accounts as and when the board feels like. Earlier, under the 56 Act, there used to be that kind of a leverage was there, which is not there under the Companies Act 2013, because it is a uniform accounting year. You have to necessarily have your accounting year starting from 1st April up to 31st March of the corresponding year. However, wherever you have any kind of holding or subsidiary companies out there, for the purpose of their, consolidation, the consolidation of your accounts, if you need to have the closure of the financial year by 31st of December, very few companies would still do have like that. Say, for example, Nestle, if you take it, it is there like that. And apart from that, Nestle, there are some more other companies are also there. So those companies, they have to take the permission at the beginning. Of course, that Companies Act 2013, when it came that point of time itself, it must have been taken initially from the NCLT. Subsequently, if I am not wrong, that has been delegated that power to the regional director of the company. Then the question comes that recently somebody asked me a question. My company is a private limited company and it is a very small company. Do I need to maintain the accounts in tele or on a computer, or till we can maintain the books in the physical mode? That means you are writing the cash book, you are writing the ledger. Answer to that is there is no mandate that you have to maintain your accounts in a tele or in SAP or in any other kind of a methodology. You can maintain your books of accounts in the physical mode also, but for the purpose of convenience, because once you are maintaining it in the physical mode, it will be very, very difficult for you to maintain that. And I have my own apprehensions that these days any chartered accountant will sit and write the books of account also. So most of the small companies also, they use this tele software is there, which is a very friendly software. And it doesn't need a kind of an, okay, by good understanding about the softwares and all those things, easily it can be managed. Then the question comes that what is an electronic maintenance of accounts and what is the physical maintenance of accounts? As far as your accounts are concerned, most of the times we are maintaining these in the electronic mode only. Only question comes, are you maintaining it on your servers? Because ROC at any point of time, he can come for an inspection of your accounts. At that point of times, you are duty bound to provide that at any point of time. So accounts are to be maintained on your servers of the companies. And some now question is that there are some companies which are maintaining the accounts in the cloud also. When you are maintaining the accounts in the cloud, and that is in an encrypted mode, and the security and all the aspects have been taken care of. There are several companies that are maintaining their accounts in the cloud. That is for the sake of convenience, for the sake of security, for so many other things are there. Comes recently, there about a couple of years before, if I am not wrong, there are certain rules have come that in case you are maintaining the accounts in the cloud, you have to necessarily have the backup on daily basis, which is to be maintained on your servers. And when you are maintaining the accounts in the cloud, that amounts to that you are not maintaining the registered office of the company. Hence, you have to intimate the ROC, number one, about that you are maintaining the accounts in so and so cloud and all. And apart from that thing, you have to also give him the details like who is the service provider. That means the cloud is maintained by which service provider. The protocols, the internal protocol of the service provider is to be given. The location where the records and all are being maintained, and the address of the cloud. And in the rules, the details have been given. These are all to be for ROC. At the same point of time, apart from the regulatory authorities, the directors of the company has to inspect the books of account also. Only thing is that in this case, that please note the directors that themselves can inspect the books of accounts. They cannot appoint their own chartered accountant or their own lawyer or somebody like that who will come and inspect the accounts. That you don't need to permit that particular director is concerned. Is according to me, as far as section 128 is concerned, this is a very important section. One need to understand that thoroughly. And at the same point of time, it is the responsibility of the company secretary. Sometimes it may so happen, with all due regards to my chartered accountant colleagues, sometimes they may not give that much kind of importance to the finer points of the legal provisions. That point of time, it is the responsibility of the company secretary to understand that and to sensitize the what's called accounts colleagues as far as the compliances are concerned. Yes, Bala.
Yeah, Gaurav, your views?
Yes, sir. The view of the sir is right, sir, regarding maintenance of account in Tally or accounting cloud software. If we there is in AOC in form AOC4, he will ask the account where it is maintained. Then we will file the same with the ROC that it is maintained on this software or and it is kept in this ROC office and registered office of the company.
Yeah, you're absolutely right.
But Sudhakarji, this corruption of accounts, is it at ground or can a company secretary be made responsible for this? Tomorrow your MCA comes and tells, look, or a LODR, your SEBI comes and tells, you're a compliance officer and how this, data got corrupted, this, that, which is not retriable and all. Now, how do you, yeah.
Sir, as per law, the company secretary is responsible for signing the financial statements.
Right.
Not the accuracy on the financial statement that how should it come, how the figure should come by the auditors or by the directors or by the auditors or by the accounting. We will, as per company secretary, at the company secretary role, you have only signed the financial statements as per section 134. He will cover the, there is company secretary who will sign the financial statement. There is no responsibility regarding that how the figure is come and how the accuracy regarding the accounts.
See,
My
Here,
point of view is my point of view.
here slightly it differs with you, Gaurav. This is what the company secretaries think, that they are not responsible for the accuracy of the figures. No doubt about it, they are not responsible for the accuracy of the figures.
Yes,
But
sir.
as far as the compliances of the company law provisions are concerned in the financial statements, they are responsible,
Yes, sir.
certainly.
Yes,
Okay,
sir.
say for example, section 186, when you are lending the money, for
Then
what
should be
purpose the
compliant.
money applies at number one, and to whom all that the money has been lent. Similarly, under section 188 and your this related
RB.
party transactions, what are there, they have to be reflected properly. And similarly, under AS 18 or Ind AS 24 are concerned, and okay, similarly, there also you have to do it. So, company secretaries are having a responsibility as far as the financial statements are concerned. Simply, they cannot wash off their hands. Yes, I agree that it is not their primary responsibility, but yes, they are also responsible for that. So my advice and submission to all the participants is, please do develop the how to read the financial statement. This is an art one needs to get, one needs to develop over a period of time. At the same point of time, what are the legalities, what are required? Say, for example, Schedule 3 is there. Schedule 3, one has to read it very thoroughly. But only thing, unfortunately, sometimes when I discuss this with the company secretary, they say that, look, that finance people take care of all these things. We have so much of work, we don't have so much of time, all these things. And okay, which is you can't say that. Number one. Number two, Atul bhai, as far as your question of concerned, data corruption is concerned. Data corruption is not an excuse at all. If, as far as the regulatory authorities are concerned, they will say, boss, it is your own headache. You should have proper antiviruses or firewalls or whatever it is and all. Data corruption has, similarly, you have to have proper backups. If at all the data got corrupted from the backups and all, you would have retrieved the data within no time. Number two is concerned, as I mentioned, that at the most you can extend your AGM by maximum of 3 months. Beyond that, ROC has no power even to give the extension to you. If you are not able to do it for whatever the reasons it may be, that amounts to a non-compliance, and the board as well as the company will be held responsible for that.
Sir, there was a debate, like I remember when I was a part of the Ministry of Corporate Affairs company nomination team. One of the issues which I've raised, during that meeting was that, is it that, company secretary should also sign the financial statement? So there was a lot of, split in the meeting, and said, look, because as a company secretary, my job is to make sure that, the laws are being complied with. Now, tomorrow, if your CFO makes any, provision, which, sometimes he makes higher provision, he sometimes, makes lower provisions. And then how can you make company secretary? And I was told in Satyam case also, the company secretary was taken behind the bar because he was the signatory to the financial statement. Yeah, your views, sir. I think you have observed that.
See, yeah. See, as I have mentioned to you, company secretary will not be held primarily responsible. If you see the section 128 as well as section 136 also, where the penal provisions are there, it talks about the board of directors, the CFO, and the person in charge who has been made responsible for the purpose of these two sections.
Yeah.
He will be held responsible. Now, the question of company secretary role is concerned. Whenever the company secretary has been appointed, one of the standard this thing is that he has to ensure the compliance with the provisions of Companies Act.
Yes.
Now, when you talk about that, for each and everything about the financial statements, he may not be held responsible. Suppose, for example, excess provision, under provision, non-compliance of accounting standards. For this, and similarly, in case of any fraud, ambiguity, irregularities are there, for this, company secretary will not be held responsible. But where company secretary will be held responsible? The balance sheet has not been presented the way it is supposed to be presented. At the same point of time, say, for example, as I was mentioning, related party transactions have not been reflected properly. their company secretary may be held responsible for that. Similarly, Section 186 is concerned, whenever you are giving that loans and other things, you have to give the information in the financial statements. Managerial remuneration is concerned, you have to give reflected properly. Similarly, auditors, audit fee and all is there. So a few areas where the company secretaries are getting directly affected, they may be held responsible, otherwise not. Even as per law also, you will be responsible only for those things which are you are responsible for. You will not be held responsible for each and everything.
So are
So
you
in case of Satyam, which you have mentioned about it,
Yeah.
Mr. Jayaraman, who was the company secretary at that point of, he could establish himself that he was not negligent in discharging his duties. He was very much diligent. That's why, if I am not wrong, he was not arrested. Number one. Number two, neither the ICSI nor the ministry has passed any kind of strictures as far as the Jayaraman is concerned. As far as the CFO, Mr. Vadlamani Srinivas is concerned, he was more or less I mean, it was proved that he was having a hand in glove with the management in the entire whatever has happened. That's why he has been arrested. Yeah.
So, sir, if somebody asks you, as your personal opinion, that the company secretary should be asked to sign the financial statement, what is your view? Yes or no?
See, but now once the legally he is under obligation to sign it, there is no question of any debate whether he has to sign or he has not to sign. Several times the representations have been given to the ministry, but ministry said under the 383A section under the old act, company secretary was the principal officer of the company. Only he has been recognized by the law after the board of directors, not even by the CFO. In fact, in those days, the CFO concept was not there. It was only that, finance head or something like that only. But he was never recognized by the law. For the first time, under the Companies Act 2013, the CFO has also been recognized as a key managerial person. And his appointment was also mandatory, which was not there under the old act. Only the appointment of company secretary was mandatory, not of the CFO. Whereas under the new act, CFO appointment is mandatory and CFO also has to sign the financial statements.
No,
Okay. So even under 2013, because you are the president at that point of time, you must be knowing better than me. The representations have been given to the ministry, but ministry has not acceded that. They said company secretary has to sign it. And whether he will be held responsible or not, ministry has not come with in the clear terms as far as that is concerned. No doubt, company secretaries, you cannot say that company secretary will not get a show cause notice if anything goes wrong tomorrow as far as your financial statements are concerned. It all depends upon how you are defending yourself, that you are not negligent in discharging your responsibilities. You are very much vigilant and diligent. Then you will not be held responsible. But you have no clue about it. You are completely in a bliss. You are in your ivory tower. Definitely, you will be held responsible. That's what my view.
Sudhakar, you're well said actually. Company secretary has to know what are the disclosure relating to financial statement has to actually found in a place. That prima facie check is supposed to ensure. For example, a small thing. You talk about the accounting policies and accounting standards you talk about initially. If the company has got the accounting policy, they will actually charge depreciation on a year-to-year basis or the diminishing method. In one particular year, they just change it to the straight line method. No problem. It is as per the act, you are permitted, you can charge, you can do it, you can charge to the accounts, you can put everything is there. But what happens when you present the books of accounts? Current year, it is on the straight line. The last year figure actually becomes in the diminishing method. The things becomes non-comparable. That is one thing. Second thing is there, okay, no problem. But as you rightly said, the fact, the change in the policy of accounting depreciation has been changed, number one. Number two, because the change, what is the impact it has made in this particular year? Number two, whether this disclosure is actually finding a place in the financial statements. It is the responsibility of the company secretary to ensure. Of course, the CFO and the auditor, they will take care. But the thing is, if it is not mentioned, equally company secretary will be held responsible.
In fact, let me tell you, when I was in Reliance, how we used to demarcate the responsibility. This may give some kind of an understanding to the participants. In fact, when the draft financial statements are ready, they used to come to our department for all the companies, not only of Reliance Industries, the holding company, but even the subsidiary companies also, and whoever the company secretaries are handling that, they have to take the responsibility for the Schedule 1 share capital, Schedule 2 reserves and surplus, Schedule 3 secured loans, and Schedule 4 unsecured loans. Because majority of this they have to compare with Schedule 3, the information what is supposed to be furnished in these schedules, whether it has been furnished or not. In addition to that, they have to go through the notes to accounts thoroughly, and wherever the Companies Act provisions are concerned, in the notes to accounts that amount that reflections are to be given, whether they have been properly given there or not, whether the information has been furnished or not, this is the responsibility of the secretarial department. Over and above that, we have to also see the draft of the the auditor's report, whether it is in sync with the financials, any qualifications, any observations, disclaimers, anything is there, which in the board report we have to reflect upon. In addition to that, whether the auditor's report the report of the secretarial auditors or not. These are all the responsibilities of the secretarial department as far as the financial statements are concerned.
Yeah, I think you can go ahead.
I think, Mayank, now you can move further.
Yeah,
We have enough discussion on 128.
yeah.
Okay. The financial concept relevant for companies. There are various financial concepts that are relevant for companies to maintain proper books of accounts. These includes accrual basis of accounting. The accrual basis of accounting recognize revenue when it is earned and expenses when it is incurred. This means that even if the company has not received payment for the goods sold
I think
and the
this
services
is fine,
rendered.
Mayank. We have discussed enough about this particular
Okay.
slide. You can go
Oh,
further. Yeah.
okay. That's Satyam case, sir.
Yeah, this also we have discussed it.
Okay. Section 129 of Companies Act, financial statements. Requirement for preparing financial statements. The financial statement shall give a true and fair view of the state of affairs of the company or companies, comply with the accounting standards notified under Section 133, and shall be in the form and forms as may be provided for different classes of companies in Schedule 3. Rule 4A, forms and items contained in financial statement. Rule 4A outlines the requirement of financial statements, specifying they must follow the forms in Schedule 3 of the Act and comply with accounting standards and Indian accounting standards. It mandates that items in financial statements adhere to definitions and requirements in the applicable standards. However, the financials of insurance or banking companies, companies involved in electricity generation or supply, or any other class of company with specific financial statement forms outlined in their governing act. Exceptions, modification, adaptation. In case of government company, Section 129 shall not apply to the extent of application of Accounting Standards 17 segment reporting to the companies engaged in defense production. Financial statements shall not be treated as not disclosing a true and fair view of the state of affairs of the company merely by the reason of fact that they do not disclose. In case of insurance company, any matters which are not required to be disclosed by the Insurance Act 1938 or Insurance Regulatory and Development Authority Act 1999. In case of a banking company, any matters which are not required to be disclosed by the Banking Regulation Act 1949. In case company engaged in the generation or supply of electricity, any matters which are not required to be disclosed by the Electricity Act 2003. In case of company governed by any other law for the time being in force, any matter which are not required to be disclosed by that law. Presentation of financial statement. At every annual general meeting of a company, the board of directors of the company shall lay before such meeting financial statement for the financial year for the approval of members. Consolidation of financial statement. If a company has one or more subsidiaries or associate companies, it must prepare a consolidated financial statement for the company and all its subsidiary and associates in the same form and manner as its own, in accordance with the applicable accounting standards. This consolidated financial statement must be present at the annual general meeting along with the company's financial statement. Additionally, a separate statement containing the key features of the financial statement of its subsidiary and associates in Form AOC1 must be provided. The provisions of the Act regarding the preparation, adaptation, and audit of holding companies' financial statements also apply to the consolidated financial statement. Rule 6, Manner of consolidation of accounts. The consolidation of a financial statement of the company shall be made in accordance with the provisions of Schedule 3 of the Act and the applicable accounting standards. In case of companies which are not required to prepare consolidated financial statement under the accounting standards, it shall be sufficient if the company complies with the provision on consolidated financial statement provided in Schedule 3 of the Act. Provided further that nothing in this rule shall apply in respect of preparation of consolidated financial statement by a company if it meets the following conditions. Ownership structure. The company is wholly owned subsidiary or partially owned subsidiary of another company, and all its members, including those not entitled to vote, have been informed in writing. The company must have proof of delivery of this notice, and if no objection are raised, consolidated financial statements may not be required. Listing status. The company's securities are neither listed nor in the process of being listed on any stock exchange, whether in India or abroad. Consolidated statement by holding company. The ultimate or any intermediary holding company files consolidated financial statement with the registrar that complies with applicable accounting standards. In case of non-compliance of accounting standards, without prejudice to any provision where the financial statement of a company do not comply with the accounting standards, the company shall disclose in its financial statements the deviation from the accounting standards, the reason for such deviation, and financial effect, if any, arising out of such deviation. Penalties for non-compliance. If company contravenes the provision of this section, the managing director, the whole-time director in charge of finance, the CFO, or any other person charged by the board with the duty to comply with the requirement of this section, and in the absence of any of the officer mentioned above, that all the directors shall be punishable with imprisonment for a term which may extend to 1 year, or with a fine which shall not be less than 50,000 but which may extend to 5 lakh rupees, or with both. It is duty of the auditor also to make observation and qualify the audit report. Failure to do so, the auditor is liable under the Act. For this, we have a case study of IL&FS, Infrastructure Leasing and Financial Services. In 2018, Infrastructure Leasing and Financial Services, a major infrastructure and financial company, revealed a severe liquidity crisis. The investigation uncovered that the company's financial statement had been manipulated to hide its true and financial health. The discrepancies included under liabilities and overstated assets. As an outcome, the revelation led to a massive restructuring of the company, with the government intervening to resolve the crisis. The company's management was criticized for failing to provide a true and fair view of the company's financial position. This case underscored the need for transparent and accurate financial reporting. Reopening of accounts.
1 minute, Mac, 1 minute. See, in section 129, whenever you are having subsidiary companies, you have to mandatorily consolidate the financial statements. And under the new act, the consolidated financial statements are also to be circulated to the members of the company. And you have to get them adopted in the AGM, and thereafter you have to file with the ROC also. However, certain leeway has been given that if the 95% of the members where the company is having share capital and majority representing 95% of the capital, if they give their no objection, then the company did not consolidate the accounts, and there are other parameters are also there. But one thing, please remember, under section 188, where the related party transactions are there between the holding company and its wholly owned subsidiary, such resolution, that means the resolution by the shareholders, is not required for the related party transaction, provided the accounts are getting consolidated. Now, when the suppose that if the company is availing this exemption, that its ultimate holding company or the intermediary holding company is consolidating the accounts, and because of that they are not consolidating the accounts, then the exemption what have been provided under section 188 subsection 1, they will not be able to avail that. So hence it is very carefully one has to take that whether to take the exemption of non-consolidating the accounts or consolidating the accounts. And similarly, when you are for 1 year you are consolidating, 1 year you are not consolidating, that is also not possible. As I was mentioning, the company has to follow consistent accounting policies. And whenever there is a accounting policy changes there, one has to give the reasons for such change in the accounting policies. And in case any financial impact is there, the same is also to be reflected upon. Yeah.
Sudhakar, there is a comment from Nirmal Shah, 95% is not there in the act.
The rules it is there, if I am not wrong, you have when the consolidation, no objection is to be given. If I am not wrong, where the company is having share capital, 95 majority number representing 95% of the share capital. The company is not having the share capital, 95% of the voting power. If I am not wrong, it is there. ND recheck that.
You are right, Sudhakar, it is there in the rules.
Yeah.
Okay. Mr. Nirmal, it is in the rule. Okay. Yeah, go ahead.
Section 130, reopening of accounts on courts, tribunal. Reopening of accounts on courts or tribunals order. A company's financial statement can be revised if a competent court or tribunal order is based on the application from the central government, income tax authority, the SEBI, or other regulatory body. This can happen if it's determined that the previous accounts were fraudulent or if there was significant mismanagement affecting the reliability of the statements. Before making an order, the court or tribunal must notify and consider inputs from relevant authorities. Revised accounts, once finalized, are definitive. Revisions can only be ordered for financial records from the past 8 years, though these periods may be extended if the central government has mandated a longer retention of accounts. And for this, we have a case study on Suzlon Energy Limited. In 2018, Suzlon Energy, an Indian wind turbine manufacturer, was found to have misstated its financial results for previous years. The company revised its financial statement to correct the error, including adjustment related to revenue recognition and cost accounting. The outcome is that the revised financial statements were audited and refiled. The company faced a loss of investors' confidence but was able to address the inaccuracies and strengthen its financial reporting mechanism. This incident reinforced the importance of timely correction and financial statement. Voluntary revision of financial statement or board's report. If it appears to the director.
1 minute, Mayank.
Yes,
Mayank, 1 minute. See that if I am not wrong, you have ignored section 129A, which is a new section which has been, if I am not wrong, it was incorporated in Companies Amendment Act 2020. And this has also been notified, and under this particular section, the central government may require some class of companies. See, in case of listed companies, anyway, they have to publish the quarterly results, and they have to file it with the stock exchanges, which in turn put it on their websites, and the stakeholders comes to know about that. In case of unlisted companies, such requirements are not there. And there was, the regulator felt that there is a need for that because there are several unlisted companies which are very large in size. They were not reflecting their, accounts with the ROC except at the end of the year only. So Section 129A was inserted under the Companies Amendment Act 2020, wherein the central government may ask some companies, some class of companies or whatever it is, and to prepare the periodical results. What is the periodicity? Again, it depends upon the central government requirement. It may be quarterly, maybe half yearly. And those accounts have to be audited or to be limited reviewed the way for the listed companies it happens. and those are to be filed with the Register of Companies within 30 days of such limited review or with the auditor. So, how many companies so far? To my knowledge, I don't think any such requirement is there. Bala, if in case you are aware of any of such things, kindly enlighten me. But to my knowledge, so far it is not there. But this provision is certainly there. What Section 129A.
Yeah, you are right. Absolutely, you are right.
Yes, sir.
Because it actually said actually the central government may require. That is the way it starts actually saying that. Yeah.
I think so far they have not, though it is notified and this is in implementation, but so far central government has not asked any companies to publish
There
the
is no
results
such
like
thing.
this.
I also not come across anything. Yeah, Gaurav, you have come
So
across
there is no
anything?
such company. There is no such company,
Okay.
as per my knowledge.
Yeah, ma'am, go ahead.
Yes, apologies for the same, sir, and thank you so much for raising this point and enlightening us on this point. So let's move ahead with the section 131, the voluntary revision of financial statement. If it appears to the directors of the company that a financial statement of the company or the report of the board may prepare revised statement or reports for any part of 3 financial years. This requires approval from the tribunal, which must be applied for in a prescribed manner. The tribunal will notify the central government and income tax authority and consider their inputs before issuing an order. A revised statement or report can only be prepared or filed once per financial year, and the reason for the revision must be detailed in the board's report for the relevant year. Where copies of the previous financial year or report have been sent out to the members or delivered or to the registrar or laid before the company in the general meeting, the revision must be confined to the correction in respect of which the previous financial statement or report do not comply with the provision of section 139 or section 134 and the making of any necessary consequential alterations. The central government can establish rules regarding how revised financial statement or director's report should be handled. These rules may specify whether the previous statements or reports should be fully replaced or supplemented with a document indicating the necessary corrections. Define the auditor's role concerning the revised statement or report. Mandates specific action that directors must take as prescribed by the rules. For this, we have a case study on Kingfisher Airlines. Kingfisher Airlines, owned by Vijay Mallya, was involved in financial mismanagement. The company's accounts were reopened after allegations emerged that the financial statement had been manipulated to obscure the true extent of the airline's financial difficulties. The outcome of this, the reopening of accounts, revealed significant financial distress, leading to the airline's grounding and insolvency proceedings. Mallya faced charges of financial irregularities, and the case emphasizes the consequences of fraudulent financial reporting. Section 132, Constitution of
I think
National Financial.
we can take the questions which are already there, I think, so before we go to this. Let me run through the questions. If there is a suggestion has come, actually, you may consider starting the series of accounting standards and the index, which is very much relevant for the company secretary to check their compliances. Anyway,
We
this is
had done earlier accounting standard, all standard one by one.
okay.
It's in past we have done, but we'll consider. I know someone has mentioned NFRA also many things. You have done the slide, but still depth they were asking.
Okay. In case of the private company, there has been a raid by the customs department. So-called notice has been issued. The demand of 6 crores of the company for managing director, part payment of rupees 1 crore made and shown as a long-term advances. This fact was not brought out and discussed in the director's report. The statutory auditors has also not bothered highlight in its audit report. More surprisingly, even such balance demand was also not shown as a contingent liability. Is it the gross negligence on the part of the directors and auditors? How auditors can actually certify the true and fair view of this? Auditors not given any clarification. How the auditors can say that the years has been actually followed when preparing the financial statement and internal controls and effective.
Yeah, you see this, as far as the show cause notice is concerned, there is a demand of 6 crores and the company has deposited 1 crore. I had no doubt about it. It was a contingent liability. It would have been shown in the financial statements. And similarly, this fact has been made the advance, whatever they have deposited under protest. Normally, whenever this kind of show cause notices are there, companies do deposit that advance under protest. So it is not a long-term advance as such. This is not an advance at all. Okay. This may be, they might be presenting it in the advances for cash and kind recoverable or whatever it is. That is a different thing altogether. But unless until it is a very significant thing, board's report is concerned, you don't need to mention, according to me, this particular aspect. Unless until that company is a very small company and it is going to have a very significant financial impact on the company at all. Otherwise, board's report, you don't need to worry about it. Now, as far as the company is concerned, no doubt about it, it is not properly reflected in the financial statements, and even auditor has not bothered about that. So definitely, if the regulatory authority notices this, they may give a show cause notice to the company for not preparing the accounts as per the requirements.
When a company takes over another company and the accounts are merged, in such a case, do we need to maintain 8 years debt or pre-merged companies?
Yes, sir. Yes, sir.
In the income tax, it is 10 years as of now, but reduced to 5 years in finance bill. And it's for our assets are there for about, if the foreign assets are there, it is for 16 years. Somebody has given the information. Do we also need to keep the physical copies of the invoice? I think this we discussed actually.
This is discussed. Already discussed.
Request to share the PPT. PPT is not shared by us. In fact, the webinar, recorded webinar is still disseminated. This is available to the people. You can access it, which contains the PPT. What exactly the maintenance of accounts in the electronic form means? I think we discussed enough this on this. I think Sudhakar explained actually on this. Small companies maintain that the data on the tally prime. Can we say that tally prime, which is a audit trail features sufficient and is it in the electronic form?
According to me,
Yes,
yes.
Yes, sir.
Yeah.
Yeah, it is in the electronic form. If it is actually the features of etc. other thing and all, it is in the electronic form. Yeah. Only primary records needs to be maintained. Beyond 8 years, vouchers and bills not required. Somebody has put it here. But as we discussed enough, I think we said so long as assessment was not completed, even the other records also required to be maintained. Okay. If the company using only the tally accounts are not maintained in cloud, this means that the AOC 4, whether it is maintaining the books of accounts or other relevant books and the papers electronic form, should we mark yes or no in the e-form AOC 4? Tally is in electronic form. If tally is in electronic form, you can mark yes, yeah.
Tally is already in electronic form. So
yeah,
you should mention in the UC4 that the reports are maintained.
As a PCS, we file the annual return from our user ID. Can PCS held responsible for books not maintained properly?
No.
PCS will not come to the picture. PCS is actually coming only on the certification part of it, not maintaining the accounts part of it. Sir, many companies do not knowledge about the audit trial applicable as of now. What is the role of this? And if you filing the annual return?
What's I couldn't understand, Bala.
Many companies and company secretary do not have the knowledge about the audit trial applicable now. What the PCS role in this when you are filing the annual return?
PCS has nothing to do as far as the audit
PCS
trial is
yes,
concerned.
Company secretary is responsible for all the company.
Just 1 minute, Bala. I think this question has arisen from that. Whatever the software you are using, whether it is Tele, whether it is SAP, or whether it is any other software you are using it, the requirement as per the accounting rules is that the audit trial should be available. That means the accounts are not to be tampered with. Whenever you are making the entry in the books of account, the recording of that time, date, etc., to be captured properly. That is what the audit trail means. So that means whatever the software you are using it, that software should be capable of also exhibiting the audit trail. Otherwise, it is not properly.
Can a private
I'm
company?
sure that Tele is having that kind of a provision.
Yeah, so Tally have the audit trail, and if it is signed by auditors, then company secretary has nothing to do with it because it's auditor's responsibility to check that.
Can a private company may adopt two methods of depreciation, WTV and SLM, for the same assets consisted in a block as on 31/3/14 and the new assets added in 1/4/14? Please clarify.
I don't think so.
No, only one
No,
account,
no.
only one depreciation method needs to be adopted.
Only,
It
yes,
cannot
sir.
be different.
In the AOC4, whether the company maintaining the books of account, other relevant books and papers are in electronic form. I don't know what is the question actually here. In AOC4, whether company is maintaining books of accounts and other relevant books and papers in electronic form. I think if you are asking yes or no on the Tally question, this is the same. Otherwise, I don't know what is the exact question is there. Pradeep? If you are
You
there,
should
you can-
mention yes.
Okay. A private limited company reports some item without having appropriate import license. Can a director certify applicable accounting standard or other applicable laws are followed under the director responsive statement, even if internal control are in place and effective?
This is relevant to the accounts and actually director should decide when they sign. Yeah, Mr. Gaurav, your view.
Well, it is basically the responsibility of the directors and the statutory auditors, because if the internal financial controls are there, then the statutory auditor mention in their independent auditor report that the internal financial controls are maintained by the company. But there are some provisions regarding this, that internal controls are mandatory for some companies and for
Now, one thing is here in this question, if I go through it, they are asking some material imported without the license. Can the director certify accounting standards and other applicable laws are followed? Obviously, other applicable laws not followed in this particular case. As far as the accounting standard is concerned, if they are followed, it's okay. So that fact has to come out now. As you rightly say, it's the responsibility of the directors and system should be in place. If it is there, it is non-compliance here under this Foreign Exchange Act imported.
Bala, in this case, what happened is, suppose it is a one-off transaction, one-off non-compliance is there.
Yeah.
As far as the directors are concerned and the director's responsibility statement, if they give this kind of a statement that they have complied with all the applicable laws of the company, and one non-compliance or two non-compliances have taken place, they can always take a shelter under the compliance certificate provided by the compliance officer. Apart from that thing, the statutory auditor also, provided that in the board processes, the what's called as the directors are not coming to know about that. On the surface, it is not coming out. Because the directors may not come to know each and every non-compliance of the company. So they will not be held responsible for that.
Okay.
Yeah.
Now the important part is NFRA role also. It will be helpful if it's like, yeah, NFRA is going to discuss in the future. That is the next topic what we are going to discuss. Also advise how to get the presentation. What was advised earlier, the same is uploaded on site and you can get, okay. Sir, section 128, maintenance of books of account. Could you please explain about the recent amendment that the company using software to maintain the books of account should have the feature of the audit trail in it? What are the responsibilities of the board and the company secretaries, auditors in this regard? Are the reporting to be made in the financial statements and the audit report?
As I have mentioned already, about this thing, whatever the software the company is being used, it has to have an audit trail ability. Okay, suppose if it is not there, that means the company is not maintaining the accounts properly. That auditor has to qualify such reports. Yes, Gaurav, if you have any comments.
Yes, sir, you are right, sir. Sudhakar sir is right. The audit trail is mandatory for each and every company from 1 April 2023.
If somebody is asking you a question, are these standards are available at Mehta and Mehta website?
It may be. It may be. I'll check and
Okay.
it was entire series was there. And we invited different auditors,
Okay.
big auditors.
If the company has got one JV company, the JV company not finalize accounts, will the company will, for the want of consolidation, or is there any option available to finalize its own account?
Regarding consolidation of financial statement, the consolidation of financial statement talk about subsidies, associates. We consolidate the financial statements of subsidies and associate companies. It not talk about joint ventures.
Okay. On audit trail is
just one minute, Bala. In this case, what happens is that JV company, if that the company is having more than 20%, obviously it becomes an associate company and you have to go for consolidation. Only thing is, for the purpose of consolidation, you don't need to have the audited accounts of the other company. Suppose that other company is having a kind of difficulty in getting their audit complete. The companies which is have to consolidate the accounts, they can take the unaudited figures, provided the auditor of the company is comfortable with that. If he is comfortable, he can take the unaudited accounts for the purpose of consolidation, and then they have to give a footnote that this particular accounts are not audited. Something like that it is to be done. But you cannot come to a stalemate that because that JV company accounts are not completed, so I cannot complete my accounts. It is your responsibility to ensure that your associate company accounts or your subsidiary company accounts are completed well in time.
Somebody is actually sharing the information. On audit trail is actually defined step-by-step requirement record, which provides evidence of the document's history of the financial transaction to its source. An auditor can trace the financial data in the particular transaction from the general ledger to its source of the document with the help of the audit trail. Tally has actually got this audit trail mechanism. Yeah, that is what we also said. The CS need to comply only with the provision of only the provision where he is mentioned. Otherwise, CS need not to worry. No, that is not correct. We discussed about the CS role right to be. Can we consider the record maintenance of the software tally standard software? Yes, it also we discussed it is in electronic form. CS has no access to the accounting records. How can he made responsible retention of the records? Does CS has no job description or legal responsibility? It is not the question of CS has got access or not access. CS is actually has to ensure the legal requirements complied with. In fact, there are people who are actually what we call the process owner. So in this particular case, it is the CFO, the finance department, they are the process owner. CS actually bring to the notice of the board of directors who are responsible for this, and through them, they have to get ensured. It is not he himself has to ensure this. Am I correct, Sudhakar?
Allah, see, this is what I'm trying to sensitize the company secretaries. Let us not live in our ivory towers that we are not responsible. Yes. The reason being the way the regulator is holding the company secretary responsible for trivial issues. Do you think he will not hold you responsible for this kind of major issues? As I was mentioning to you, if I am the regulator, I will hold the company secretary responsible for non-compliance of the Companies Act provisions. Section 128, Section 136, Section 130, 129, or 130, 131, whatever the sections may be. Chapter 9 is concerned, it is the responsibility of the company secretary to comply with or get it complied through your finance colleagues. That is your headache. As I told you, you may not be held responsible for the financial regularities, but you are certainly responsible for the compliance with the provisions of Companies Act. So let us not live in our ivory towers. let us what's called understand the importance of the chapter 9 and develop the ability to understand the financial statements and the compliances of the same.
So that here, it can be like that, like for a certain provision where we are responsible to ensure like investment, loan and all that, where the limit is there about that. We create a communication that because it is placed before board. So even in balance sheet, when you sign, you say that it does not cross the limit of resolution and all that. These are all secretarial provisions. As regards certain provisions which can be said that it is the prime responsibility of accounts and finance, at least they can write it to this department and ensure that as it is presumed, it is ensured that the same is maintained and getting then also it is fine that you have taken the responsible position of yourself and take a assurance from the respective department, which will help you in future if any problem is there. What your view is there, both panel, Mr.
See,
Gaurav?
I think before you join, Atul Bhai was there and we had a long discussion on this particular issue.
Okay,
Yes, sir. Already discussed.
okay.
Either financial and subsidiary associates necessarily to be approved by the respective boards before giving it to the consolidation of the holding company. I think Sudhakar has explained actually. In case it does not happen or something like that, you can take the auditor. That's what he said actually. Audit trial followed is not properly. The auditor will look into this. As a PCS, do we need to comment in the audit trial in the annual return?
No.
Is the CS to be made responsible for the chapter 9 also on not to have the ivory tower, then he needs to be a whole-time director. I think I am done with the questions. So, Gaurav, I think you have a limited time because now it is already 12:30.
Yes, sir.
You have a long way to go. Yeah.
Yes, sir. Thank you, sir. Thank you. I will leave.
Let
Okay,
us
sir.
move.
Section 132 of the Act, Constitution of National Financial Reporting Authorities. The central government may constitute a national financial reporting authority to provide for matters relating to accounting and auditing standards under the Act. The NFRA shall perform functions as follows. Recommendation: advise the central government on developing accounting and auditing policies and standards for companies and or other auditors. Monitoring and enforcement: ensure compliance with the accounting and auditing standards. Quality overview: oversee and improve the quality of services provided by the professions, ensuring compliance with these standards. Additional functions: perform other functions related to the above responsibility as prescribed. The NFRA will be led by the chairman with expertise in accountancy, auditing, finance, or law appointing by the central government. The NFRA will also include up to 15 other members, both part-time and full-time as prescribed. Each division of NFRA will be led by the chairperson or a full-time member designated by the chairperson. An executive body consisting of the chairperson and full-time members will manage NFRA functions effectively. The terms and conditions and appointment procedures for the chairperson and members will be prescribed. They must declare any conflicts of interest or lack of independence to the central government. Full-time members cannot be associated with the audit firms or related consultancy firms during their tenure and for 2 years after. The NFRA has the following powers and responsibilities. Investigation. NFRA can investigate professionals or other misconduct by members or firms of chartered accountants either on its own initiative or upon a reference from the central government. No other institute or body can pursue misconduct cases if NFRA has already stated in investigation. Civil court's power. NFRA has the power similar to those of the civil court under the CPC 1908, including ordering and discovering the production of books and documents, summoning individuals and examining them on oath, inspecting books, registers, and documents of any person involved, issuing commission to examine witnesses or documents. If professional or other misconduct is proven, the NFRA can impose penalties. For individuals, penalties ranging from a minimum of 1 lakh up to 5 times of the fees received. For firms, penalties ranging from the minimum of 5 lakhs to up to 10 times of fees received. Debar members of firms auditing, prohibit them from being appointed as auditor or internal auditor or from conducting any audit of financial statements or internal functions of any companies or body corporate. Valuation, prohibit them from performing any valuation as provided under section 247. The debarment can last for a minimum of 6 months and up to 10 years as determined by NFRA. Any person aggrieved by any order of NFRA may prefer an appeal before the appellate tribunal. The NFRA shall meet at such time and places and shall observe such rules and procedures in regards to the transactions of business at its meeting in such manner as may be prescribed. The central government may appoint a secretary and such other employees as it may consider necessary for the
I
effective
think
performance.
Mayank, 1 minute.
Yes, sir.
Considering the time constraint, NFRA is more concerned with the audit firms. Actually, say that what is one of the reasons for the constitution of NFRA is to 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 keep an eye on the ICAI, because the regulator was not very happy the way the ICAI is handling the disciplinary related issues, considering the scams and the role of the auditors are concerned. That's why an extra uh, regulatory authority has been constituted. And NFRA is a complete subject altogether. And according to me, Bala, correct me if I am wrong, for this presentation, the understanding of the NFRA that much is not required, because section 136 and 137 are, according to me, very important. Apart from that thing, whatever the questions also we have to discuss about if any participants are having it. That's why let us skip this particular portion is concerned. Bala, I leave it to you.
Agreed, sir. Agreed. Agreed. It is more of an audit and auditor concern. We can give. Yeah.
Yeah.
Shall we proceed, sir?
Yeah.
Yeah, go ahead.
Okay. Rights of members to copies of audited financial statement. Distribution of financial statements. A copy of financial statements, including consolidated financial statement, if any, the auditor's reports and other documents required by law must be sent to every member of the company, every trustee for debenture holders and other entitled person. This must be done at least 21 days before the date of the general meeting. Exceptions to the 21-day rule. If the documents are sent less than 21 days before the meeting, they are still considered duly sent if the company with the share capital members holding a majority who represent at least 95% of the paid up share capital giving a right to vote agree. In case of without share capital, members holding at least 95% of the voting power agree. Central government prescriptions. The central government may prescribe a specific method for circulating financial statement for companies with certain net worth or turnover. For listed companies, the provisions are considered met if the documents are made available for inspection at the registered office during working hours for at least 21 days before the meeting. A statement with salient features of the document or copies of the documents is sent to every members and trustee not less than 21 days before the meeting unless shareholders requires full financial statements. Website publication for listed company. Listed company must place their financial statement, including consolidated statements, on their website. They must also place audited accounts of each subsidiary on their website. For foreign subsidiaries, if required by the law of the foreign country to prepare consolidated financial statement, those statements should be placed on the website. If not required to be audited and does not get audited, the unaudited financial statement can be placed on the website along with an English translation if the statement are in another language. Apart from the requirement given under the Companies Act, the listed company has to follow SEBI LODR regulation 2015 also. Next, the inspection of documents. Members or trustee must be allowed to inspect the documents at the company's registered office during business hours. Companies with subsidiaries must provide copies of the unaudited and unaudited financial statement of each subsidiary to any member who requests them. Penalties for non-compliance. For companies, it is 25,000. For officers, penalty rupees 5,000 for each officer in default. Rule 10, statement containing salient features of financial statement. The statement containing features of documents referred to in first proviso of subsection 1 of section 136 shall be in Form AOC3, provided that the companies which are required to comply with the company's Indian Accounting Standard Rules 2015 shall forward their statement in Form AOC3A. Exceptions, modification, adaptation. In case of Section 8 company, in subsection 1 of Section 136, for the word 21 days, the word 14 days shall be substituted. In case of Nidhi company, Section 136, subsection 1 shall apply, subject to the modification that in case of members who do not individually or jointly hold shares of more than 1,000 rupees in face value or more than 1% of total paid up share capital, whichever less, it shall be sufficient compliance with the provision of section if an intimation is sent by public notice in newspaper circulated in the district in which the registered office of Nidhi is situated, stating the date, time, venue of AGM, and the financial statement with its enclosure can be inspected at the registered office of the company, and the financial statement which enclosed are affixed in the notice board of the company, and a member is entitled to vote either in person or through proxy. Manner of circulation of financial statement in certain cases. In case of all listed company and such public companies which have a net worth of more than 1 crore and turnover of 10 crores, the financial statements may be sent by electronic mode to such members whose shareholding is in demat form and whose email IDs are registered with depositories for communication purposes. Where shareholders is held otherwise than the demat form, the to such members who have positively consented in writing for receiving by electronic mode and by dispatch of physical copies through a recognized mode of delivery as specified under section 20 of the Act in all other cases.
1 minute, Mayank. As far as section 136 are concerned, there are two major points which one has to observe is accounts are the financial statements are to be sent to members of the company within 20 days notice. Okay, and then of course now it is very clear 21 plus 4, so total 25 days the accounts are to be circulated, and the notice is also to be given along with that. Another important feature is that AGM can be held at a notice with the consent of the members, 95% or 100%, depending upon when you are holding the AGM. Most of the times it happens that the company secretaries take the approval of the shareholders or members of the company holding the AGM, and they keep it on record also. Especially this happens in case of private companies, closely held public companies and all. They forget to also take the consent of the members for circulation of accounts are concerned. When the regulator comes for inspection, when your AGM is held at a shorter notice, and if you are not able to the consent for circulation of accounts also on a time period less than 21 days until both the approvals are in place, otherwise section 136 non-compliance will be there. Number one. Number two, wherever you have, in case of listed companies, wherever you have subsidiary companies, that the subsidiary accounts need not be attached to the holding company account. The salient features are to be given. In case any members are asking, the subsidiary company's financial statements are to be provided to such shareholders. The question comes that, in fact, at one point of time, as we know that there are some professional shareholders who always trouble the companies and company secretaries. In one company secretary asked me one question that one of the shareholder is saying that the subsidiary company financial statements have been provided, but not the board's report and the notice of the AGM of the subsidiary company have not been provided. So he is insisting that these are also to be provided. Otherwise, he is going to complain to the ROC. And ultimately, the company, because the subsidiary company's AGMs were not even convened, and the board only accounts were audited, the board's report and all are to be prepared. In fact, several times people think that the accounts, when they are audited, the the adoption of accounts will be subsequently takes place. The board's report can also take place subsequently, not necessarily to be in the same report only. Second thing is, if you see the definition of financial statements, it is only balance sheet, profit and loss account, cash flow statement, and notes to accounts thereon. That's it. Report is not a part of financial statement. AGM notice is not a part of financial statement. So whenever you have to circulate, I mean, whenever a shareholder is asking you for the financial statement of the subsidiary companies, you don't need to give your board's report and your AGM notice. Please take care of this thing, number one. Number two, in fact, section 137, when Mayank is going to discuss, point of time, you have to also file all the documents, whatever you have placed before the members at the AGM. Those are to be filed with ROC. A question comes that whether AGM notice is to be filed with the ROC. Technically, no, because AGM notice we are not going to place before the shareholders at the AGM. So technically, you don't need to file the AGM notice with the ROC. All other documents like your balance sheet, profit and loss account, board's report, auditor's report, cash flow statements, and all other financial statements, you have to do it. One more question also is that several times this comes that whether the annexures to the board's report are to be signed or need not be signed. Whoever is signing the board's report, if the chairman is signing the chairman, otherwise the two directors are signing the two directors. All the annexures to the board's report are also to be signed by whoever the people signing the board's report, except one report, that is CSR report, which is to be signed by the chairman of the CSR committee and one more director. So please, I thought these are all the relevant points. I thought I will just bring it to the notice of the participants. Thank you.
Very important, Lakhan. This was very important. Thanks.
Not only that, while signing the report, necessarily the DIN number is invariably is required to be mentioned. There have been n number of cases where DIN number is not mentioned. People have taken for a task. Yeah.
Rights of members to copies of audited financial statement. Filing requirement. General requirement, a copy of financial statement, including any consolidated financial statement and all required documents are specified under the Act, must be filed with the registrar within 30 days of the date of annual general meeting of the company. These filing must include all documents that are required to be attached to such financial statement under the Act. If financial statements are not adopted, if the financial statements are not adopted at the AGM or at adjourned meeting, the unadopted financial statement must be filed with the registrar within 30 days of the AGM. These will be treated as provisional records by the registrar until the financial statements are adopted at the adjourned AGM, and the final adopted statement must then be filed within 30 days from the adjourned AGM. For one-person company must file the financial statement duly adopted by its member along with all the required documents within 180 days from the closure of the financial year. Foreign subsidiaries. For subsidiaries incorporated outside India which have not established a place of business in India, their financial statement should be filed with the registrar. If the foreign subsidiaries' financial statements are unaudited as required under the local law and are in the language other than English, the Indian holding company must file this unaudited statement along with the declaration and a translated English copy. If AGM is not held, if AGM for any year has not been held, the company must file the financial statement, required documents, and a statement of fact and reason for not holding AGM with the registrar within 30 days of the last day by which AGM should have been held. Penalties for the same for companies, penalty is rupees 10,000. Continuing failure, an additional penalty of rupees 100 for each day the failure continues up to a maximum of 2 lakh rupees. For director and officers, penalty is rupees 10,000 rupees. Continuing failure, an additional penalty of rupees 10 for each day after the first day of failure up to a maximum of 50,000 rupees. These penalties applies to the managing director, CFO, and any other director charged by the board with responsibility for compliance. In their absence, all directors are liable. Rule 12, filing of financial statements and fees. Filing of financial statement. Standard filing. Financial statement must be filed with the registrar using Form AOC4 if applicable. Consolidated financial statement should be filed with Form AOC4 CFS. NBFCs, Ind AS AS compliance. NBFCs are required to comply with the Indian accounting standard should file their financial statement using Form AOC4 NBFC Ind AS. Consolidated financial statement, if any, should be filed with Form AOC4 CFS NBFCs Ind AS. CSR. Form CSR2, companies subject to CSR provision must file a report on CSR using Form CSR2. This form must be filed as an addendum to the financial statement forms AOC4, AOC4 XBRL or AOC4 NBFC Ind AS. Form MJT7 is a statutory form prescribed under the Companies Act 2013 for the annual return of a company. This form must be filed with the registrar and provides detailed information about the company's shareholding, directors, and other key aspects. The form must be filed within 16 days from the date of the AGM of the company. XBRL filing. Mandates filing. The central government may notify a specified class of companies that are required to file their financial statement in extensible business reporting language XBRL format. The manner and specification for such filing will be outlined in the notification. Definition. XBRL is a standardized language used for electronic communication of financial information, enabling easier and more efficient reporting and analysis. Fees. The fees or additional fees for filing of financial statement as specified in Section 137 and its second proviso and Section 2 are detailed in the company's registration office and fees rules 2014. For this, we have a case study of Yes Bank Limited. Yes Bank, a major private sector bank in India, faced issue with the timely filing of its financial statement. The bank was found to have delayed in filing its financial statement with the ROC in violation of Section 137, which mandates timely filing. The delay affects investors' confidence and public perception. The outcome of this is that Yes Bank imposed its compliance practices to ensure timely filing of financial statement in the future. The bank faced penalties for non-compliance with filing deadlines. Internal audit. Such class or classes of company as may be prescribed shall be required to appoint an internal auditor who shall either be a chartered accountant or a cost accountant or such other professional as may be decided by the board to conduct internal audit of the functions and activities of the company. The central government by rules prescribed the manner and intervals in which the internal audit shall be conducted and reported to the audit committee where it is applicable or board. Exceptions, modification, adaptation. In case of specified IFSC, public company section 138 shall apply if the articles of the company provides for the same. In case of specified IFSC, private company section 138 shall apply if the articles of the company provides for the same. For this, there is a case of Manpasand Beverages Limited. Manpasand Beverages, a beverage company, faced issues with internal control and auditing. The company's internal audit processes were found lacking, failing to comply with Section 138, which mandates internal audit provisions for certain companies. The outcome is the company was required to enhance its internal audit process and controls. The company faced scrutiny from regulator regarding its internal audit practices. Rule 13, companies requires to appoint internal auditor. The following class of companies shall require to appoint internal auditor, which may be either individual or a partnership firm or a body corporate, namely every listed company, every unlisted public company having a paid up share capital of 50 crores or more during the preceding financial year, turnover of 200 crores or more during the preceding financial year, outstanding loans or borrowings from banks or public financial institution exceeding 100 crores or more at any point of time during the preceding financial year, outstanding deposits of 25 crores rupees or more at any point of time during the preceding financial year, and every private company having turnover of 200 crores or more during the preceding financial year, or outstanding loans and borrowings from the banks or public financial institution exceeding 100 crores or more at any point of time during the preceding financial year. So this brings to us a conclusion here. So the conclusion, the maintenance of books of accounts is essential requirement for every company registered in India. Proper books of accounts not only ensures compliance with the law, but also helps in making informed business decision. Companies should ensure that they maintain accurate and complete books of accounts. Thank you, sir. The presentation is over.
Okay. We'll look into some of the other questions. Audit document is to be uploaded within 6 months of the audit. Is it applicable to the listed company or non-financial company or all the companies? I think it is for all the companies because that is what the law says actually. Okay, NFRA supervision, is it not for all the professions, CS, CMAs and lawyers? No, NFRA, as he said, categorically, it is only mentioned for the statutory auditors. Because the preamble, if you look at the NFRA, it says is oversee the function of the statutory auditor. That is what is mentioned there actually. Can the digital signature DSB affects in the director report and their annexes? Yeah, digitally it can be signed, no? It is permitted. There is no physical signature or something. So digital signature is done actually. Sir, is it CIN of the company is compulsorily required to be mentioned in the financial statements? I think SIN number goes only with the communication which are made to the thing, because this is being a filing
The
requirement.
financial statement not required.
Not required at all. Okay. Can private limited company be appointed as internal auditor?
You
No.
can, why not?
Yes, sir. They will appoint. Voluntary, they will appoint.
I'm not clear why section 138 relating to the internal audit is actually inserted in the chapter 9 as it don't relate to any business processes, functions, activity of the company or not necessarily to the financial statement of the company.
But sir, private limited company can be appointed as an internal auditor. That's a question. Akshar, what is your view? Akshar, you are there?
Yeah, it can be, it's possible. Private limited company can be appointed as an internal auditor. There is no specific criteria that only the CA firm or some finance qualification people require but that private limited should be from finance field. But it can be appointed.
Yeah, because if you see the act, internal auditor can be either the chartered accountant or cost accountant or any other suitable person who can carry on the job in the opinion of the board of directors. It doesn't necessarily talk about the, CA or CMA qualifications. Even I have seen many companies who are become MCOM qualified people, they've been also acting as an internal auditor. Sir, NFRA, cost audit, secretarial audit, investigation by all the three also prescribed under the Companies Act? No, NFRA, I don't think it is. Sudhakar, NFRA is...
One minute, Bala. See, NFRA got for all the three institutes. But as of date, it is more focusing on the chartered accountants only. So far, they have not taken up any matter relating to cost accountants or company secretary institutes. Because when the NFRA has been constituted, it has been given a jurisdiction over all the three institutes. If any kind of disciplinary issues are there, NFRA can take care of that. Jurisdiction is there, but as on date, it is more focused on the CA related issues only.
Yeah. So all the top chartered accountant firms, they are under NFRA. NFRA is observing all reforms.
If you see the adjudication orders, which is actually published in the NFRA, I only see the chartered accountants, statutory auditors who are actually coming around. I have not seen even a single case of any other auditors actually. I think that is all the questions I have. If anybody is willing to raise a hands and other thing and all, we can permit them for question. But so far, I don't see any hands risen actually.
Yeah.
Yeah, there is one.
Yeah. No, I think Disha has raised it. I think it's.
Hello, I'm Geeta.
Yeah.
Sir, actually, whole-time director wants to act as an internal auditor of the company. Is it possible to act as an internal auditor of the company? Hello?
Whole-time director.
Yes.
Whole-time directors wants to act
How
as
can it be a conflict of interest is there? How can the whole-time director of a company can act as an internal auditor of the company?
But sir, if I'm been appointed as a whole-time director, and I'm given a charge of internal audit, I think possible. No, I mean, because
Because it is a conflict of interest, you are doing the audit and you are the person who is responsible, who is the whole-time director.
So
Actions.
maybe whole-time directors
You cannot.
can be, functional directors. Suppose I'm also CFO and a director. I'm also
Yeah, it's like that only. Yes,
yeah,
yes.
something like this. And
See,
now,
as I was mentioning to you,
Sudhakarji.
Your voice cracks, Sudha. You cannot like.
no, I am saying that Deepthi, it is a conflict of interest. I am the person for the management of the company, and I am the person who is the internal auditor. That means what? I am conducting the audit own affairs. So there is a conflict of interest is there. There is no bar as such. There is no prohibition, but conflict of interest is there. You have to appoint somebody as an internal auditor. He may report to you. That is a different thing altogether.
So according to you, legally no prohibition, but there is a conflict of interest.
Correct.
As a good corporate governance, we should not keep a director as a part of the internal audit committee. We can appoint somebody from the finance team, and we can constitute an internal audit team. That's a good practice.
So in many companies, there is a company secretary who is also a director. So the same logic, why not whole-time director and audit?
See, Bala, company secretary who is a director is a different thing. There is no conflict of interest. But if the whole-time director is also the internal auditor of the company, then there is a conflict of interest. That's what I said is, there may be an internal auditor who may be an employee of the company. Let him report to the whole-time director. There is no issue. But if he is responsible, if he is the internal auditor, then there is a conflict of interest.
There is a VS come from Mr. Chartered Accountant Rajagopalan. Functional director cannot be an internal auditor as he has an interest in the function of the
That's
company.
what I said, conflict of interest.
It's a conflict of interest. That's what he says actually. Yeah.
Okay, even
That's what I
the
said.
it says CA rules will not be allowing. That's what Uday Kishore says. Even the rules do not allowed for the directors to become a but very tricky question. Geeta, thanks for this question.
There is no
Thank you, sir.
there is no specific restriction in the act as such.
Okay.
Okay.
Yeah.
But what employees will say that if I am directly reporting to that director, like director itself be an internal auditor, why to take the risk of that? That's what they may question of that. That is a issue.
Anyway, I think you require some separate session for this. Yeah.
Geeta,
Yeah,
anyway, you are raised a very interesting question. Huh?
Thank you, sir. Thank you so much.
Yeah. Yes, sir.
I think there is no other hands or reason I can see here. I think we address all the questions.
Yeah.
I think we can close the session, but I can tell you only before you close, Dipti, your last words. Even now, after past 1 o'clock also, we have about 182 people. It definitely shows what is the importance of this topic and how much we learn. Today, as Sudhakar has put it, company secretary has to go a long way when it comes to audit. I also come across many times. Oh, accounts, we have no way concerned. That is the way it is actually happening. That should not be the case. We should not be, remain aloof from this matter. That is definitely required. Because in many companies, company secretary and CFO, they sit together even much before 3 months before the audit only, they have the long chat and how to go about it and other things. Sometimes there are many other issues out there. So company secretary has to definitely get involved, especially when it comes to the disclosure matter, etc. And Mike has nicely brought out the presentation, very nicely has presented all the section discussed. Thank you very much for the night for your good presentations. Thanks a lot for Gaurav sharing your thoughts. Sudhagar,
Thank you, sir. Thank you,
I will not say separately thanks to you because you are as usual exemplary. Last word to Dipti.
Okay, thanks everyone. Mr. Gaurav, thanks a lot for your time.
Thank you, ma'am. Thank you. Thank you.
Mayank, wonderful presentation. Yes,
Thank you, ma'am.
Thanks, Mr. Bala. Okay, thanks everybody. Have a good holiday.
Have a great
Thank you.
weekend.
Thank you.
Thank you.
Thank you so much.
Bye.
Sudhakar ji, thank you. Thank you, everyone. Thank you.
Thank you, sir.